Thank you, Ryan, and thank you to you all for coming out tonight. It really means a lot to us to see all of our clients. And for those that I haven't met face-to-face, feel free to introduce yourself after the presentation. So I want to spend some time to start off going over mutual funds and ETFs, some of the differences between the two. Can everybody hear me okay back there? Some of the differences between the two, and why we prefer ETFs as a general rule of thumb to mutual funds. When I say mutual funds, I'm referring to the traditional actively managed mutual funds that a lot of people are familiar with, where you have a portfolio manager and a team of analysts picking stocks. And as you can see, there are a few points that I want to point out as far as the buy and sell decisions. It's discretionary with a portfolio manager, whereas ETFs are much more rule-based. Capital gains distributions, especially in taxable accounts, you're getting those capital gains distributions whether you want them or not. Expenses higher in traditional mutual funds, ETFs is lower. And then transparency, you only see what that mutual fund manager is holding on a quarterly basis, whereas on a daily basis, you can look inside an ETF and see what it's holding. Now, I put the technical aspects up here, but I think it's good to review this with an example from real life. Imagine you're at a grocery store and the bagger asks you paper or plastic. Right? I'm sure it's a situation that everybody's been in before. However, at this particular grocery store, they have a technology that allows them to produce these plastic bags that are biodegradable, they're 100% transparent, and most importantly, they're extremely inexpensive to produce. So they give their customers a discount for choosing the plastic over the paper. So in this example, the groceries are going to stay the same, but the method with which you transport them is much more efficient and cost-effective using the new technology, and that's really what ETFs represent here, whereas the mutual fund industry is represented by those paper bags in that example. And just to continue with that point, the expense ratio for one of our core holdings, which is the broad market index, is 0.03%. What that means is for every $100 that you have invested in the fund, it costs you 3 cents. Compare that to the average actively managed large cap mutual fund, coming at 0.89%. You can see the difference is huge between those two. And that really makes a difference because every year that active manager has to clear that hurdle of almost 1% to justify the fees that they're paying. Now, some quick portfolio changes. Steve touched on them earlier, but I wanted to bring this up again because I really want to focus on the US stock section, where we added value-focused, equal weight, and minimum volatility funds. And so the coming sections are going to be the reasons behind them and some of the benefits of having those types of strategies in your portfolio. Now, when you construct an index, there arises the question of how to weight the individual stocks within that index. Popular indexes like the S&P 500 are traditionally market capitalization weighted, meaning that the bigger companies get a bigger weight within that index, so they can become somewhat top-heavy. Equal weighting is just as it sounds. You take the same 500 stocks and you spread it evenly across, and the thought process behind it is fairly straightforward. As companies grow in size, it becomes harder for them to grow at the same rate that they once were able to grow at. For instance, a $1 trillion company, it's much harder to grow that at 10% than it is to grow a $1 billion company at that same 10%. And equal weighting an index looks to solve that problem. As you can see here on the chart, out of the top 100 performers in the S&P 500 every year, on average, 78% of those come from non-mega cap companies, so more down the mid cap and the small cap part of the line. So equal weighting as a strategy has already been in Bouchey Financial Group portfolios via our technology sector. We recently added some to the broad market index. Now, if you peel back and look at the benefits long-term for having an equal weight strategy in your portfolio, you can see the blue line represents the equal weight S&P 500, and the red line represents the standard S&P 500 ETF. Now, a question might come up, well, why don't we just do all equal weight? Because they perform better at different points in time, just like everything else. Over the last 5 years, the market capitalization weighted S&P 500 ETF has drastically outperformed its equal weight counterpart. I'd like to take a second just to discuss growth and value styles of investing. A few of you might be familiar with this, but I just wanted to touch on each of them. Now, a growth strategy is where you are paying for the future growth of a company. And companies that fall into this category are your Googles, your Amazons, your Microsofts, where investors are expecting a large growth in the earnings in the future, so they're willing to pay top dollar for that. Value resides on the opposite end of the spectrum, where you're buying companies for cheap. You're buying companies on sale in the hope that they eventually get back to fair market value. As you can see, they do better during different points in the economic cycle. Growth tends to do better during expansionary periods, where value tends to do better during slowing or contractionary periods. Now, we recently added a value style fund to our portfolio, despite the fact that, as you can see in the last 10 or so years, growth has really won out. And the growth outperforming value is represented by those red bars on the bottom. And it should be noted that the Bouchey portfolios are still, I would say, a majority growth-oriented, and they have been growth-oriented over the last 10 years, which we've benefited from incredibly. But we made a change because we want to get ahead of the curve before that tide starts to turn and before the winds start to change. We made the change via our partnership with Dimensional Fund Advisors. For those of you who are unfamiliar with Dimensional, they are real pioneers in the game of delivering value strategies to the masses. They've been around for almost 40 years. They have 4 Nobel Prize winners on staff. And I'd like to point out that Bouchey Financial Group is the only firm in this area that has passed through the vetting process that Dimensional puts its prospective advisors through. And the reason they do that is because they want to make sure that the advisors using their funds are philosophically aligned with them as a company. So I'm proud to say that we are the only company in this area that has gone through that process. Again, I had a great poll question. And actually, it leads into my next one, so maybe I'll just take one from the audience. If you had an investment that had declined by 50%, does anybody know the rate of return that you would need to get back to even? 100. Perfect. 100. But I like where your head's at. Yeah. So the point being here is that as things decline in value, it becomes harder to make it up on the way back. And a minimum volatility strategy somewhat flies in the face of traditional financial or investment theory where more risk equals more return. Everybody's familiar with that saying, right? Minimum volatility strategies look to limit the downside on that portion of the portfolio so it becomes easier to make that money back up as the markets recover. So if you look at this chart, you can see, and again, the blue represents the minimum volatility strategy that we just added. The orange or red, sorry, I'm colorblind. The orange or red color represents the broad market index and the performance over the last 8 or so years. Now you can see that they end up in somewhat of the same place. However, they took different paths to get there. During periods of low volatility like 2014 and 2017, the broad market index outperformed. But during periods of market volatility, you can see that the minimum volatility showed its true colors. And that's really why we wanted to augment the current holdings in our portfolio with the minimum volatility strategy, because the true essence of a diversified portfolio is having things performing differently at different points in time. So just a quick summary. We'll never uproot our investment philosophy. It's the core of who we are as a firm. We merely trim the hedges around the edges. Adding different investment styles like equal weight, like value, like minimum volatility, increases diversification within the portfolio. And we will be continuing to deliver portfolios at the lowest cost possible.